Hey guys, Canal here from Level Traders. In today's video, we'll be covering another aspect of technical analysis, this time trends and channels. We'll look to cover specifically what trends and channels are, how to identify trends, and how to trade breakouts of trends. Before we go into today's video, we'll briefly recap what candlestick charts are and how to read them. Thanks again for watching. If you do find the content useful, remember to subscribe. Take care, folks.
A candlestick chart is a style of financial chart used to describe price movements of a security, a derivative, or an FX pair. Each candlestick will represent a different time frame, so it can be daily, weekly, hourly, or even minutes. So for example, if a trader is looking at a daily chart, each candlestick will represent one day. Below we have a couple of examples. Typical candlestick, which is either a bearish candlestick or a bullish candlestick. In terms of the similarities, so the first similarity is the high and the low will be the same regardless of whether it's a bearish or bullish candlestick. So if it's red or green, it's still the same point for the high and the low. All that represents is the volatility, the magnitude of the movement in the price in that time frame. The main difference is where the price closes. So if the price closes within that time frame higher than when it started, it'll be a green candlestick, and vice versa. If the price closes below where it opened, it'll be marked as a red candlestick, and that is the main difference between the two. So everything else is the same. It's simply the price of where it starts and where it finishes determining the color of the candlestick. Let's have a quick look at a couple of typical examples. So I've got two candlestick charts here. One is the Nasdaq 100, so the US index, and the second one is Amazon, which is a component of the Nasdaq 100. The first thing you can see here is the first thing that jumps out is obviously you've got the red and the green candlestick. So as we said, you can see where buying and selling occurs straight away. You can see that. So for example, if we look at the Nasdaq 100, you can see from early to 2020, you can see the selling, mainly because they're all red candlesticks right down up until mid-March. And if you look at the Nasdaq, for example, you can see May onwards, they're all green. So all bullish, all buying signals. Now, the other thing that sticks out here is the size of each candlestick is not the same, as you'll see. What that tells you is, one, it tells you the volume, but it also tells you the magnitude of the move. So you can see here the bars in Q1 last year. You can see they're quite big, right? So the size of the move was big, and the selling was severe, as you can see. Vice versa here. You can see in Amazon, what is that? That's just before May. So April, the size of the green bar is big. So there's big buying there, big buying. And then you've got that again in July, where the bars are quite big for the green. You've got a big red candle following it, but you can see the size, the magnitude of that move. Conversely, if you look at the Amazon chart between September and November 2019, there's not a lot of movement, right? You can see the size of the bars are minuscule, tiny. So what that suggests is very little volume, very little trading, or what it could represent actually is the buyers and sellers are cancelling each other out. So the movement is very narrow. The range is narrow. So when we go to our candlestick, the highs and lows are not going to be far apart. Hence why the size of the bars are quite small. So what is a trend or a channel, and how are they formed? A trend forms as price begins to develop a general direction over time. This time horizon can be monthly, weekly, daily, or even minutes. Though be warned, longer time horizons will give a better picture of a trend. For example, a minute chart might not show clear trends at all. And then we come on to how they form part. So firstly, we have uptrends, which are made of consecutive higher highs and higher lows. The opposite of that is a downtrend, which are formed with consecutive lower highs and lower lows. The example I have here is a downtrend. I'm using a daily chart. We can see that the FTSE 100 between June and September last year was in a downtrend. The channel I've drawn, very simple. All I've done is I've taken the high from early June, August and mid-September, and I've connected those points together. For the lows, I've taken the low towards the end of June, the start of August, and the start of September. Now you could have taken the start of July as another point as well. There's no perfect or exact science to this, guys. And what you can now see is a channel that is downward trending. What this gives me is entry and exit areas. So if I want to go long, want to buy the FTSE, or if I want to sell, want to go short, I now have areas or points where I would look to do that. Trend trading is very popular. It's one of the most popular strategies, I would say, out there. A lot of traders are trend trading because it's very easy, very simple, and it works really well. The other thing is, there's a famous saying, a trend is your friend until it's broken, of course. Or not a trend. I think it's something like that. Anyway, moving on. I know what some of you are thinking. Wait, didn't I miss one? What if there's no trend, right? Yes, you are right. There is a third and final piece of this jigsaw, which is markets that have no trend. So the example I've used here is the euro dollar. Again, I've used the daily chart here, and what you can see is between mid-July and end of September, prices move sideways, and it's moved between 117.20 up to the max of 120. Now you can still find trades here, right? Maybe you buy at 117.20, you sell at 120, or even 119.05 as I have there on the chart. But what majority of traders will tend to do is they'll sit on the sidelines, or they'll step away from this market for the time being until it breaks out somewhere. Reason being, there's too much uncertainty here. There's too much uncertainty. It's a 50-50 in terms of which way it can break. And the risk is it breaks against the direction you're trading because there's no direction. So traders tend to step away here. That's why trend trading is much more popular. When there's a trend, it's easier to follow. And with this type of sideways movement, consolidation, there's usually an uncertainty when prices move like that. So you're never quite sure which way it might break.
Okay, let's now have a look at trends within different time frames. So here I've got GBP USD, the currency pair, and we can see it's in an uptrend. Why is that? Because we have, since late September last year, prices formed higher highs and higher lows. Again, I've circled these points, which we can connect the dots, so we get a rising channel, right? Now the same pair, same currency pair, GBP USD, however, this is a 1 hour chart. All of a sudden, this is showing a different trend, right? With consecutive lower highs and lower lows. So, what does this mean? Daily time frame is in uptrend, but the 1 hour time frame is in downtrend. Now, there's two things that can happen here, guys. One is traders look to make a quick profit, so they short sell the currency before buying it back, so it maintains the medium to long term uptrend. Or the selling gathers enough momentum that it breaks the medium to long term uptrend, i.e. we get a trend change. So if we go back one slide, you'll see if we take the previous high point, you see where we've got this retrace? That effectively is your short term downtrend. Now it's possible if the selling is so strong that actually you get to the lower bound and even break the lower bound, in which case we get a trend change. So it's important to watch not just the long-term time frames, but also look at the intermediate or short-term time frames as well. That can give you clues
whether there are any trend changes. Right, so let's have a look at an example of that. So here's an example of what a trend change does look like. So you got one of the best performing stocks of last year, Tesla Inc., one of the favorites for everyone. What you can see here is a weekly chart, and this weekly time frame, what I've drawn out here is the uptrends and the downtrend in red. So you got the uptrend in blue, downtrend in red. And what you can see here is the stock between November 2019 to March 2020. This was in an uptrend. However, end of March, this changed. Everything changed. Pandemic hit, and what you had was the lower high was breached, got taken out, and we ended up going south, and a trend change occurred. So this is when the downtrend started. Then at the start of April, price stopped short of making a lower high. Remember, our definition of a downtrend is consecutive lower highs and lower lows. All of a sudden, we stopped short of making the lower high, and instead we made a new higher high. Definition of uptrend: higher highs and higher lows. So this became the start of a new uptrend for Tesla, which to this case is still the same. It's still an uptrend. So what this chart shows is how quickly trends can change and how price reacts to a trend change. Usually what you get is a big price move. Price moves a lot when a trend is broken, which can point to either you get out of the way. If you're riding the trend, all of a sudden the trend changes, or if you're not in the stock or whatever asset it is, it might lead to an opportunity where, because the trend is reversed or changed, you might see an opportunity there either to go long or short